Bank run imminent. The $10,000 withdrawal limit is coming. Get ready. At 5 p.m. today, banks closed their doors and a rule went live that changes everything. By Monday morning, your money is not really yours anymore. They chose Friday for a reason, so you would not notice until it is too late. $500 maximum withdrawal, 7 days to access your own account. And if you try to move it to gold, crypto, or silver, they flag you. They freeze you for 30 days. This is not theory, this is law. Greece, Cyprus, Lebanon, it started exactly like this. And now it is here. The question is not if this affects you. The question is, do you have 48 hours left? Welcome to the financial forensics. Now, before we go any further into what just happened to your bank account, I need you to do something for me. You see that subscribe button? I know everyone asks you to click it. But here's the thing. If you are over 50, if you have seen a few economic cycles, if you remember when a handshake actually meant something, then you understand that information like this does not come from the evening news. It comes from people who read the fine print, page 500 of regulatory filings, the documents they bury on Friday at 5 p.m. So do me this favor, hit that subscribe button. Not for me, but for yourself. Because what we're about to walk through in the next few minutes could be the difference between being prepared and being trapped. And while you're at it, drop a comment below. Tell me where you're watching from and whether your bank has already started acting strange. I read every single comment. Now let us follow the trail because the evidence is becoming impossible to ignore. In March 1933, something happened that most Americans today have never heard about. President Franklin Roosevelt closed every bank in the country for an entire week. He called it a bank holiday. But it was not a holiday, it was a lockdown. During those days, no one could take out their money. Rich or poor, it did not matter. The government decided when the banks would open again. They also decided which banks would survive and which ones would die. This was the Emergency Banking Act. It gave the government total control over the banking system. And here's the part that should worry you. The law was never fully removed. Pieces of it still exist in today's rules. Think of it like an old fire alarm still wired into a building. It may look outdated, but it still works. One flip of a switch, and it activates. Now, something strange is happening. Recent Federal Reserve documents have started referencing emergency liquidity protocols that trace back to 1933 language. Why would regulators dust off a 90-year-old playbook unless they expect to use it? The question no one is asking publicly is simple. Are they preparing for a crisis, or are they watching one form right now? The blueprint exists. The precedent is set, and the wiring is still live. Most people believe their bank has their money sitting in a vault. This is not true. Banks keep only a small fraction of deposits on hand. The rest is loaned out or invested elsewhere. The system works fine when everyone stays calm. But when too many people want cash at the same time, the math breaks down fast. Right now, regional banks across America are showing stress signals that the mainstream news is not covering. Their cash-to-deposit ratios are dropping. Some have fallen to levels not seen since the months before the 2008 financial crisis. Think of a gas station during a hurricane warning. The pumps look normal until everyone shows up at once. Then suddenly, the tanks are empty and the lights go dark. One strange data point stands out. Several mid-sized banks have quietly increased their borrowing from the Federal Reserve's emergency lending window. This is the same tool banks have used when they were in serious trouble in 2008 and again in 2023 during the Silicon Valley Bank collapse. Why are they borrowing now if everything is stable? What do they see coming that we do not? The cracks are forming beneath the surface. And just like the 1933 blueprint showed us, when liquidity dries up, control measures follow. Here is something most people do not realize. Banks do not need new laws to limit your withdrawals. The legal framework already exists. It is sitting quietly in the fine print of your account agreement. Buried in those long documents you never read are clauses that allow banks to delay or restrict access to your funds during times of unusual circumstances. The language is vague on purpose. It gives banks wide power to act first and explain later. This is not theory. In 2019, the Federal Reserve updated its Regulation D rules. These changes gave banks more flexibility in how they manage deposit outflows. At the time, nobody paid attention. Now those changes look like preparation. Think of it like a landlord adding a new clause to your lease while you're not looking. The rule is already there. They are just waiting for the right moment to enforce it. One disturbing irregularity appeared recently. Several major banks have updated their terms of service in the past 6 months. The new wording expands their rights to impose withdrawal holds during systemic events. What exactly counts as a systemic event, and who decides when it starts? The answers are unclear, but the legal tools are ready. No vote required, no public warning, just activation when the moment arrives. In 2013, Cyprus shocked the world. The government froze bank accounts overnight. People woke up unable to access their own money. When banks finally reopened, withdrawal limits were strict. Many could only take out a few hundred euros per day. Greece followed in 2015. ATMs were limited to 60 euros daily. Bank doors stayed locked for weeks. Life savings became trapped behind government orders. Then, Lebanon in 2019. Banks imposed informal limits without official announcements. People simply could not withdraw large amounts anymore. The system quietly choked off access. These were not third world countries. These were modern economies with banking systems similar to ours. Now watch what is happening in America. The patterns are different, but the direction feels familiar. More paperwork required for large cash withdrawals, increased questions from tellers about why you need your own money, delays that did not exist 2 years ago. One bank manager recently told a customer that withdrawals over $8,000 now require 24 hours advance notice, not because of a law, just new internal policy. Think of it like water pressure dropping before the pipes freeze. The flow slows first, then it stops. The international playbook is clear. Capital controls never announce themselves with sirens. They arrive quietly, one small restriction at a time. The number $10,000 appears everywhere in banking regulations. It is not random, it is strategic. Any cash transaction over $10,000 triggers an automatic report to the government. This has been law since 1970 under the Bank Secrecy Act. The government says it fights money laundering and terrorism, but it also creates a detailed map of everyone moving serious cash. Now that same number is appearing in a different context. Internal bank discussions about withdrawal limits keep circling back to $10,000 as the threshold. Why this amount specifically? Think of it like a fence built at exactly the height where most people cannot climb over. It is high enough to control the majority, but low enough to seem reasonable. Here is the strange part. $10,000 in 1970 had the buying power of about $75,000 today. Yet the reporting threshold never changed. It was never adjusted for inflation. This means the government now tracks far more transactions than the original law intended. One forensic analyst pointed out something odd. If withdrawal limits arrive, $10,000 would trap roughly 80% of typical large withdrawals, while seeming generous enough to avoid immediate panic. The question remains unanswered. Is this threshold about security or about control? And why has it stayed frozen for over 50 years? Smart money moves quietly. It does not wait for headlines. It watches signals that ordinary people miss. Right now, unusual patterns are forming among wealthy individuals and institutional investors. Private vault storage companies report a surge in demand. More people are moving physical cash and precious metals into secure storage outside the traditional banking system. One high-end storage facility in Texas said new client requests doubled in the past 8 months. These are not conspiracy theorists. These are business owners, attorneys, and retired executives. Think of it like animals leaving an area before an earthquake. They sense something coming before the ground shakes. Another strange signal appeared in real estate transactions. More buyers are trying to close deals with larger cash components. They want money converted into hard assets now, not sitting in bank accounts later. Cryptocurrency exchanges also show an interesting shift. Withdrawals to private wallets have increased significantly. People are pulling digital assets off platforms and into personal control. Why this sudden move toward self-custody across multiple asset classes? What information are these individuals acting on? The pattern suggests preparation, not panic. These moves take planning. They indicate people with resources and connections are quietly positioning themselves before something changes. When smart money starts moving in the same direction, it rarely happens by coincidence. The evidence points to a timeline that most people are not watching. The pieces are moving into place, but the final trigger has not arrived yet. First comes the preparation phase, legal frameworks updated, emergency lending windows quietly accessed, bank terms of service changed. This phase is already complete. Second comes the stress phase. Liquidity problems emerge at smaller institutions. Cash reserves tighten. Borrowing between banks increases. We are currently in this phase right now. Third comes the signal phase. This is what to watch for. Major financial media will start running stories about responsible cash management and a digital payment safety. Banks will send friendly emails encouraging online transactions over cash withdrawals. Regulators will give speeches about systemic stability measures. These are not warnings. They are preparations for public acceptance. The final phase is activation. It will likely happen over a weekend when markets are closed. An announcement will frame it as temporary and necessary. The word protection will appear many times. Think of it like watching storm clouds gather. The wind picks up first, then the temperature drops. By the time you hear thunder, the rain is seconds away. The countdown is not measured in years anymore. The patterns suggest months, possibly weeks. And the final warning will be brief.